future. We're talking real money.
Hello, friends. Welcome to another exciting Friday edition of the Talking Real Money podcast. This is the Q&A day edition of the Talking Real Money podcast, where you send in your Q's and then I answer them with answers. If you want to send in your questions, it's easy. Just go to talkingrealmoney.com and click on the contact form, and then you can record them into your microphone on your computer or your phone or whatever it is. You can also type them in, and then Tom will answer those during a future podcast or show or something, or Tom or I. So send in your questions. It's just that easy, and we love answering them. And let's just get started with our first question, because we have more now. We have more questions, so I can fill the show out a little bit better. Here we go.
Hi, Tom and Don. Thanks for all that you do. Really enjoy the show. I had a question about the possibility of adding CLOs to my portfolio, either, in addition to or possibly in place of bonds as a debt asset. I saw some of the major companies, specifically I was looking at the BlackRock ETF CLOA as a AAA rated CLO, portfolio, and what sort of place that might have in my portfolio. I'm relatively young. I'm under 30, and I have a fairly high risk tolerance, and I'm really looking to kind of maximize growth for the foreseeable future in my accumulation phase. Thanks for all that you do. Looking forward to your response. Take care.
Oh, our friends on Wall Street are masters of gimmickry. A CLO. I see many of you shaking your heads, wondering what the heck is a CLO? Well, it is when you hear the name, you're going to go, wait, that sounds vaguely familiar. It's a collateralized loan obligation. And if you're wondering why that sounds familiar, well, there used to be, many years ago, a lot of collateralized mortgage obligations, or CMOs, and collateralized debt obligations, or CDOs. They were Wall Street's Frankenstein monster. As a matter of fact, these kinds of securities were in large part responsible for the market meltdown of 2008, because what a CLO, a CMO, a CDO is it is a pool of a certain type of debt. In this case, it's lower quality paper from corporations. And what Wall Street does is, through what they believe to be their infinite wisdom, takes all of these big pools of debt and then slices them and dices them into things called tranches. Does that word sound familiar to you too? Yeah. What happens sometimes is these tranches don't behave as expected. So right now, you may have a tranche that sliced off some cruddy paper that's the safest part of that tranche, and it gets a AAA rating. Does anybody remember back when some of these CDO and CMO tranches lost their AAA ratings and plunged into junky territory? And I think that's what nearly took down the biggest insurance company in the world, AIG. It took down Lehman Brothers and Bear Stearns. It was collateralized debt obligations. So do these sound safe? Now, I know you say you can take risk, but this is a foolish place to take risk. Why take risk to get what is currently a 6%, 6.5% income stream? Now, that alone, by the way, should tell you that these cannot be comparable to AAA rated treasuries. Oh, they're not even treasuries aren't AAA rated. That this can't be comparable to AAA rated corporate paper. It can't. It's a game they're playing. And it'll work right up until it doesn't. When will it stop working? I don't know. Do you know? You don't know either. These are highly dangerous. If you want to take risks that might be rewarded in the future, and you're as young as you are, these are not the place for you. Why pay that kind of money? The fees are high. Just focus on stocks. Focus on a well-diversified stock portfolio. Increase your small cap allocation. Increase your value. Get some international. Get some emerging markets. Those are where the risk is and where the risk has been, in the past anyway, more than adequately rewarded. So, no, don't touch. This is the latest in a long line of gimmickry from Wall Street. They will give you what you want. What do you want? Higher yields. What else do you want? Safety. They'll give you the appearance of that right up until the day it doesn't work. As a matter of fact, I was reading a thing in the Wall Street Journal about one of Donald Trump's properties, and the rating agencies are downgrading the debt on that. So it can be what was AAA can suddenly become not AAA. And when it's complicated, you're not likely to have a clue what's going to happen. And these things are complicated. I mean, read up on them. These are bundles of below investment grade paper that are sliced up to make AAA paper somehow. It sounds like magic, or at best, alchemy. I don't know. But I bet you someday when things get really bad, they stop working. I just don't want to be holding that bag when it stops working. Thank you for your question. I truly appreciate it. Send in your questions, talkingrealmoney.com. Also, check out the summer road trip coming up in some very obscure little towns across America. I don't think I'm hitting a single really big one except maybe the Minneapolis area. I think everything else is pretty small. Trying to do the back roads. So check it out at talkingrealmoney.com. Ask your questions at talkingrealmoney.com. Here's our next one.
Hey, Tom and Don. This is Nick from Ohio. Been listening for several years. Very, very appreciative of everything you guys have done. Learned a lot, changed the way I'm investing, and it's just super, super appreciated. So I have two questions. I'm 34. I am following Paul Merriman's 10 fund best-in-class ETFs, which I won't rattle all of them off, but I made a one adjustment, and I want your take on it. So I dropped the 14% of the REIT and replaced that with 14% more of the AVUV small cap value. My, I guess, logic or thought behind that is just knowing the difference in historical returns, and knowing I have 30 plus years of time ahead of me. I thought taking a more aggressive tact made more sense for me. Scored high on the risk quiz, high 80s on the risk quiz, so I have no concern with that. So curious on your take.
Well, this correspondent had two questions, so I've split this up. So we're going to have like a couple of two-question people. So we'll have more questions than usual. First question, AVUV. If it's truly to be more aggressive, then I'm okay. But I want you to think about it for a minute. Are you doing it because you want to be more aggressive, or are you doing it because you don't feel good about real estate as an investment right now? That's the question. I think in an attempt to be more aggressive, it makes sense because the real estate portion of the portfolio is likely to be a slightly more stable asset class, at least if the past is any indication. And the small cap value over time has dramatically outperformed real estate investment trusts. So from those two perspectives, yeah. But if you're using it as a timing kind of thing, don't try that. Just build the portfolio so you have the diversification. The reason for the real estate is to reduce volatility. It's really not there to increase returns. You have asset classes that don't move the same way at the same times. And that's the reason for that being in there. And that's the reason for bonds. I mean, you could say, well, I'm not going to use the bonds in Paul's portfolio because I want to be more aggressive. If it's just to be more aggressive, then it makes sense. Now let's get to your next question.
My second question is, I know you can't really be sure of much in life, but I am about as sure as I possibly can be that I will have a sizable inheritance. It's an only child situation. There's nobody else, who would be in the mix to get the inheritance when that time comes. So I'm just curious if knowing with reasonable confidence that there'll be a large sum of money, some years down. Would that, in your opinion, change any of the investing strategy or the amount I'm accumulating, anything along those lines? Just kind of curious if that would change anything, or just keep doing what I'm doing and take that as it is when it comes. So again, appreciate everything. Thanks so much.
Well, no, it wouldn't change my investing strategy. Again, well, one, you said it. You can't be sure of anything. Something could happen that could cause your parents to need to use all that money. Who knows? Some health catastrophe, or they get mad at you and they decide to give it all to charity or whatever it might be. So no, I would not change the way I invest. If it was an absolute certainty, you could change the way you invest. I still wouldn't necessarily do it, but you could, because we talk about a risk profile. And a risk profile is the ability to handle volatility, which is what risk is when you're diversified. It's nothing else. It's just volatility. The ability to handle volatility and how much need you have to take risk. For example, if you have an income stream, you have a pension that's going to take care of you for life, and you have plenty of money set aside for rainy days and the like, then you don't necessarily need to take more risk. But do you want to? If the answer is, yeah, I want to, I'm okay with it, then no, don't change anything. Thanks for your questions. And here's our next one.
Hi, Don. I live in the state of Maryland, and I'm considering opening 529 accounts for 4 grandchildren, none of whom live in Maryland, but it appears that I get a good tax break at the state as well as the federal level by opening the 529s through the Maryland program, which is managed by T. Rowe Price. And I have heard you speak not glowingly about T. Rowe Price. So I'm not sure if it's worth it to get the tax advantages to use their program. They have several funds that they offer for this balanced portfolio, bond and income portfolio, equity index 500 portfolio, equity portfolio, extended equity market index portfolio, global equity market index portfolio, inflation-focused bond portfolio, social index equity portfolio, and U.S. bond index portfolio, as well as money markets. I would rather be in something that is going to earn money so that it increases by the time my 6-year-old through 12-year-olds need the money for higher education or to roll over into an IRA if they don't use it for college. And I'm wondering what you think of the idea of using the Maryland 529 program managed by T. Rowe Price versus another 529 program that might give me better options for investment. I will wait to hear your Friday Q&As. Thank you very much.
And thank you very much. Those folks in the Maryland government are very loyal to their local Baltimore money management company, T. Rowe Price, but they're loyal to the expense of those who use the plan. Because a couple of things. One, we don't believe that active management, and we have the fact, we don't just believe it, we have the facts to back it up, that active management over time has not shown any evidence of beating indexes or passive style funds. It just doesn't exist. So why do you pay the extra money? And those T. Rowe Price funds run about 0.6% in that 529 plan, whereas you can be at 1/6 that in the Utah plan and some others that have Vanguard and the like. So is it worth it? Well, if your goal is to make more money for the kids, then the answer is no. If your goal is to help you out short term, and it's not very big, by the way, it's $2,500 per account or beneficiary in contributions. And in Maryland, I don't know how high your income is, but your maximum state tax is 5.75. So if you're below that, that becomes a very small number in terms of how much you're actually going to save on taxes. Very, very small number, depending on where your bracket falls. I would tend to go elsewhere. I just think you have better odds of success because of the fact that non-actively managed funds have generally shown a tendency to outperform. And we know that lower fees put more money in your pocket or your grandkids' pockets. So I would probably skip the Maryland 529. Thanks for the call. Thanks for listening. Here's our next one.
Hey, Tom and Don. Love the show. Question for you on rebalancing, which I know is a very common topic or point of discussion on the show. But I don't quite understand how that practically occurs within, in my case, a 401k. Based off some guidance from Tom from several months ago, I no longer do a target date fund in my 401k. Instead, I'm invested in particular funds that are global, international, value, and so on. I'm 41 years old and I'm okay with risk. And I currently have an 85 to 15% split in favor of stocks, which I would like to continue for the foreseeable future. As far as the rebalancing goes, am I supposed to look at my overall portfolio within my 401k and calculate the 85-15 based off a share value, a dollar value, or how do I calculate what percentages in each bucket? And then from there, I'm assuming, because this is self-directed, if my stocks are overweighted, for example, I would need to go in and pick a certain fund and sell some of those shares and then reinvest that money into one of the bond funds that I am in within my 401k. Just trying to get a sense of how you actually do what seems like a fairly common topic, and I just want to make sure I understand it correctly. Thank you very much.
Rebalancing is not really hard. Again, we tend to try to make things more complicated. I do it on a dollar basis because to do it any other way gets too confusing, and it all ends up being about dollars anyway. So if I had a portfolio with $100,000 in it, and initially I wanted 50% in U.S. and 50% in international, just very simply, and a year from now, my U.S. was up to 60% of my dollars, or $60,000, and my international was down to $40,000. Well, I would sell enough of the U.S. to get me to $50,000 in each account. And I would just do that. Generally, they have a period where you can change investments, and that would be the time when you would do that. Dollar amount, just make sure every year you're close. I mean, if it's 51.49, why bother? If it's 55.45, it's probably worth bothering. You want to do it regularly, but not too often. And when it really does make a financial difference. So that's what I would do. And I just discovered that the next question is also you. So let's do that one.
Hi, Tom and Don. Another question for you. This time it relates to the 3-bucket strategy. In particular, the brokerage account. I currently have a 401k that I have just now been able to max out at 41 years old, with 2/3 roughly going to pre-tax and then additional third going to Roth within the 401k. I've also, within the last several years, opened up a Roth IRA, which I'm able to fund at roughly half the amount of the annual limit. My question is, when should I turn my attention to a brokerage account? I understand that it's important to try to have 3 buckets to allow flexibility and options as you approach and get into retirement. But where I am not fully funding my Roth IRA at this point, should I start a brokerage account anyway so that I have time to let that grow between now and retirement, which for me is probably, we'll say, roughly 25 years away? Appreciate it. Thank you very much.
I'd actually prefer not to refer to different accounts as buckets because they're not really buckets. Buckets are like the equity bucket and the bond bucket, or different types of investments to get diversification. We believe you should fund those things that are in your best interest first and fully. For example, you want to fund your 401k totally up to the match. Then you want to probably fund a Roth IRA unless you have great fund choices at work. Then you fully fund your 401k as you're funding your Roth IRA. And you're not maxing out the Roth IRA yet, so there's no reason to have the brokerage account. You only have the brokerage account when you've run out of other places to put the money, and you make enough money now, or you're saving enough money that you need to put it somewhere, and the only option left to you is in a brokerage account so you can buy ETFs and build your portfolio in another place. We talk about withdrawing not because it's important to have the three, just to answer the question, in which order should I take them? If you never had a brokerage account and you just had a bunch of money in the 401 and the Roth, then the order, you wouldn't withdraw from the brokerage. It's not important to have it. It's just the other kind of account you can have. So you would start with your 401k, the pre-tax dollars, and then last go to your Roth IRA, which is growing tax-free. So no, there's no need. There are no buckets. I really hate the term buckets. I do. I try not to ever use them because they've been misused by so many people that I think we start to get confused and think that there are essential buckets you should have. There are no essential buckets except the buckets you need to mop your floor or to catch the drip in the ceiling, which you should probably fix. Anyway, thank you all for your questions. These were good. This was fun. I appreciate it. I love these shows. And if you get a chance, call in. Well, you can wait. On Saturday, you can call in your question. Every Saturday from 3 p.m. to 5 p.m. Eastern, pretty much without fail, except for Christmas, Tom and I get together and talk with you live on a radio show in the Seattle area, but we turn it into a podcast the next week. The phone number is 855-935-TALK, 855-935-8255. 3 to 5, noon to 2 Pacific, every single Saturday, call. And also, send your questions in at talkingrealmoney.com on the contact form, and check out my upcoming summer road trip where, by the way, Tom will be flying to Madison, Wisconsin to meet some of you folks in the Midwest if you want to drive into Madison and have an actual free advisor meeting where he'll look over your portfolio. I, on the other hand, am not doing that across the country. Mine is more sit around a campfire and chat at one of the campgrounds I visit, or if you have someplace cool we should go, then we'll go there. Like one listener has a dairy farm, so we're going to their dairy farm. It just sounded like fun. So check it all out. It's all at talkingrealmoney.com, and it's really easy to do all the things there. You can meet with an advisor. You can check on the trip. You can ask questions. You can listen to the podcast. You can read a whole bunch of great articles. There's tons of stuff at talkingrealmoney.com. Thank you so much for being there. Tell your friends and relatives and acquaintances, and join me again next Friday as I'm answering questions and really talking real money.
The opinions and views expressed on this podcast were current on the date recorded. Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions.
Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy.
Information presented on the podcast is not personalized investment advice from Rapella Wealth. The views and strategies described may not be suitable for everyone. This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction. Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appella Wealth, a fee-only registered investment advisor.
Please see Appella Wealth's ADV Part 2A on our website for information regarding Appella's fees and services.
Appella Capital, LLC, DBA Appella Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Appella does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. I think I need a nap.